Let's talk about the empirical asset management, asset allocation portfolios. Portfolios are used to build and preserve wealth. They work best when a client's risk tolerance is matched with one of the risk tolerant portfolios. What they offer is sophisticated risk controls. 20 independently identified risks are controlled in these portfolios with a keen additional focus on non-normal risk, including serial correlation, fat tails, and correlation breakdown. These are the things that affect you most when times get tough in the marketplace, 2008, 2000, 2020. The benefits are that you get good and up and down capture ratios. Participation, if you will, on the way up with some protection on the way down. And again, they're core portfolios covering the full risk tolerance spectrum with 5 different risk tolerant portfolios, conservative to aggressive and 3 in between, so you can dial in risk appropriately. As you can see, all the portfolios over time build wealth. Green does better than black, the benchmark. Asset allocation template. Conservative on the left, aggressive on the right. You can see there's more equities in the aggressive on the right and less in the conservative on the left. There's equities, fixed income, and alternative with subcategories thereof. Inside of that framework of asset allocation template, we do a lot of controlling of risk, 20 different independent risks. And to give you a sense of how we think of the world a bit different than most asset allocation portfolio companies or asset allocation portfolios, let me just set the table. Here's a typical bell curve, all right? And this is just stocks. You can see an average 8 to 10% return. One standard deviation is -10 to 28%. That's a broad range of returns. And actually at 30-year returns will fall outside of that, even wider returns. Why do people typically diversify? Green, adding bonds and alternatives, if you will. Maybe they lose a little bit of return, 6 to 8%, but look at the scope of the returns they've narrowed. So it's easier to live with in any given year. You don't have such a broad range of returns. That's the essential reason most people will diversify. But the facts are green is more like a science experiment. It's flipping coins, rolling dice. It works that's a perfect bell curve. In the real world of investments, it's more like red, where you get these fat tails. In other words, you get more events, let's look on the left, which are big losses than you should get in a normal bell curve. And that's because of all the emotion and crowd think that goes into the investment world. So momentum picks up in both directions and creates these outsized number of serious down events. In that left tail would be events like 2008 and 2000 through 2002 and 1987, 2020. And I think we had some of this go on in 2015, 16, and 18 as well. So you get these extra nasty events that take place. Well, we take that very seriously because if you look at the correlation of risk assets in the left tail, which is really negative events, you see that the correlation of risk assets is very high. Said another way, when stocks go down, everything goes down. And then you're left with everything going down, and it's very frustrating, and your performance may suffer. In the right tail, correlations are low and sometimes negative. So that's diversification at work, and it's at the wrong time. That's when things are good. You don't need diversification at that point. Most asset allocators and asset allocation firms build portfolios assuming that correlations will be lower than what you see in that left tail. And then when things melt, they've got a tough story to tell. We take that very seriously. I'm going to show you 3 things we do to adjust to make sure we have some protection when those really tough events occur. That left tail are called non-normal risks. Here's a chart you'll see every down year for the S&P 500 since 1929. And to the right of that, you'll see the Treasury bond in comparison. So that's your standard reason for diversification. You can see bonds hold up much better, especially in the tough markets. To the right of that, though, where there's data, you'll see that corporate bonds don't do nearly as well as the treasuries. And most asset allocators use corporate bonds in their asset allocation template. We do not do that. We only buy government bonds. And the reason why is in these 5 experiences, we'll use 2008 as our example, where you see that medium-term treasuries were up 20% in 2008, whereas medium-term corporates were down 10%. That's a 30% difference. That's so meaningful that it makes no sense to us to pick up an extra 1.5% yield along the way, year by year, only to get kicked in the teeth at the exact wrong time. It affords us better protection in a tough environment. An even better diversifier, we call the ultimate diversifier, is gold. This is a correlation chart. In the middle of the chart, you can see 0. Above that is positive correlation. Below that is a negative correlation. So you can see correlations are not static like many asset allocators believe. They move around. And gold does exactly what you need it to do. When times get tough in the stock market, correlations actually go negative, which means stocks go down, gold goes up at the exact right time. It does the opposite of all the other asset classes that we showed you in the left grouping and that left tail. It doesn't increase in correlation, it decreases. It goes to a negative 0.5. Look at those red circles. 1987, the recession in 1991, 2000 through 2003, 2008 and 9, and more recently. So we get that diversification benefit at the exact right times. Third one, this is a little bit futuristic. Commodities, you can see relative to equities, what this chart displays, commodities are at about the cheapest level they've ever been at. And this fancy Russian guy figured out that commodities run in long-term cycles, the Kondratiev wave, as he called it. And we are at the bottom of one. Our allocation, because of this analysis, increased commodities in 2019 and have been benefiting us ever since because commodities have taken off, done very well. So the natural question I think anybody should have is, great story, working really hard at your non-normal risk, but does it work? When combined all together, you'll see, yes, that's the case. In 2008, this is live performance, our conservative portfolio up top outperformed its benchmark by 1,000 basis points or 10%. It was up basically 1% with the benchmark down 9. And you can see all the models all the way down to aggressive down the bottom, which is a little over 400 basis points, all had significant excess performance versus their benchmark. So in the toughest market, if you want to call it that, our activity really benefited. The non-normality focus really worked. That should kind of beg the next question, which is the left side of this chart. I looked at all the tough years out of the 13 that these portfolios have been run, and looked at the toughest of those years to see how we performed. Now, none quite as bad as 2008, but you'll get a sense here in the tough markets. The story rhymes. It kind of does the same thing as 2008 did in these portfolios. To the right of that, you're going to see the combination of the good years and the bad years. So this answers the question: do you give up all the protection you afforded in the down markets by underperforming in the up markets? Well, that's not the case, because you can see we have straight up excess performance versus our benchmarks. Straight across the 5 risk tolerant portfolios. And to the right of that, circled in red, you'll see we're actually doing that straight up excess performance with less risk. Betas of 0.63, 0.8, 0.9, 0.97, and only 1/1, which is the aggressive portfolio, 101, excuse me. Conservative portfolios, 0.63 implies we have 63% of the risk, and yet we still outperformed. Another way to look at risk is up and down captures. And you'll see we have the right ratios: more up, less down. Participation with protection, as we said. It's not certainly not perfect, but it's we see many asset allocation firms that have kind of the opposite of these on the up and down captures. Here's a view of our conservative portfolio. Certainly not perfect, a couple down years in there, but the consistency of this, I think, speaks volumes, and I think it's worth a look. Going forward, we feel that there's a significant risk in asset allocation and fixed income bonds in general. You can see from this chart, from the end of World War II to 1981, rates did nothing but go up. And ever since then, they've done nothing but go down. But they reached a floor when COVID-19 hit and the Fed dropped rates down to basically zero. They don't really have anywhere to go but up. This has been a boon for the last 38 years for any asset allocator, because what happens when you buy stocks and bonds, let's call it a 60-40 mix, a moderate portfolio, your stocks are generally going up with a couple of nasty sell-offs in 87 and 2000, 2008, and all the like. Every time they did, bonds went up big time. People jumped into bonds as a safety net. That was great. Bonds were doing their trick as a diversifier. Along the way, bonds did terrific. What they did is rates were going down, so you were getting appreciation in those bonds while you were getting a decent yield because rates weren't at zero. And then you got this big bomb insurance. Every time the stock market melted, they gave you some protection. Perfect world. Here's the problem. We think we're going back to more of an environment on the left side, like on the left side of this chart after World War II, where rates really have nowhere to go but up. And what does that mean? Let's just look at the three scenarios that bonds afford in an asset allocation portfolio. Let's say rates just stay flat. They don't go up or down, they stay flat. There's no appreciation because rates aren't moving. There's little yield because you're close to zero. And there's not as much hedge left when stocks go down heavily, evidenced by the fact that in 2020, bonds didn't give the type of hedge they did in the past. They went up about half as much as they used to go up in down markets for the stock market. That's because rates are too low. You don't get that protection as much. That's a bad scenario. Next one, rates go down. Well, you get a little appreciation along the way, but not a lot because rates are close to zero as it is. And you're still getting no yield or close to no yield. And your hedge is still limited as well. So that's not a good scenario for bonds. Let's take the third scenario, see if we can find a good scenario for bonds. Rates go up. Well, now you don't get appreciation, you get depreciation. You lose money, said another way. You might have a little extra yield, but yields are still too low to offset that depreciation you're going to get. And your hedge is still limited as well. So there's really no good scenario for traditional fixed income. We've made serious adjustments in that regard. This is prior to COVID and rates being dropped to zero by the Fed. This is the asset allocation template afterwards. You didn't notice the differences, I'm sure. It was too hard. So we made it easy. We put in the changes here, not the net numbers, but the changes. In green's positive and red's negative. You can see we've actually increased equity exposure because you have to pick up some return, and they're more competitive than the bond front, mainly in mid-small and international, specifically emerging markets. Fixed income, serious change here. The traditional fixed income has dropped significantly, short, medium, and long, and moved toward something that benefits when rates go up. That's really important, and that's TIPS and duration managed products. Very helpful in a rising rate environment. Alternatives, they increased as well, although they increased significantly in 2019 as this strategic shift was taking place. Our models picked that up, and you can see gold specifically really became a much larger component of our portfolios. So we're picking up return and hedge, not in fixed income, but more in other areas of the marketplace, alternatives, managed duration, TIPS specifically. That's an overview of our asset allocation portfolios. Thank you.